You know, it's not every day that a single White House nomination can directly rattle your savings account, your mortgage, and your 401k, but that's exactly what we're looking at with Donald Trump's pick of Kevin Warsh to lead the Federal Reserve. This one decision sent immediate shockwaves through the markets, and we really need to break down why it matters so much to your wallet.
And boy, did the markets react. I mean, it was instantaneous. The second the news broke, everything started moving, and fast. It all kicked off with one huge, blinking question: what on earth just happened to the price of gold?
Well, this happened. A 5% drop in a single day. Now, for an asset like gold, which is supposed to be your steady, safe bet, that's not a dip, that's a crash. We're talking about the biggest one-day drop in decades. Something clearly had investors running for the hills.
At the exact same time, the US dollar shot up, having its best day in months. And this is where it gets really interesting, because usually gold and the dollar are like a seesaw, right? When one goes up, the other goes down. To see both make these huge, dramatic moves at once, well, that signals that the market is bracing for a massive fundamental shift in policy.
And hey, if you think gold got hit hard, you should see what happened to silver. It got hammered, down a staggering 13%. So yeah, this wasn't just some minor market tremor. This was a full-on earthquake, and the epicenter was one guy.
All right, so who is this person with the power to cause this kind of chaos in the financial world? Let's meet Kevin Warsh.
So Warsh is no newcomer to this world, not at all. He was actually the youngest Fed governor in history and was right there in the trenches with Ben Bernanke during the 2008 financial crisis. He knows the Fed inside and out because he was in the room when some of the biggest decisions were made. After his time at the Fed, he landed at the conservative Hoover Institution, and he was even a finalist for this very same job back in 2017. So he's a total insider, but one with a very specific reputation.
You see, during his time at the Fed, Warsh got a label: inflation hawk. Now, what does that mean? It's simple, really. He's a policymaker who's more worried about inflation than pretty much anything else. He's the guy who's always ready to raise interest rates to keep prices from spiraling. In fact, he was famous for pushing back against the Fed's huge stimulus programs after 2008, worrying they'd cause big problems down the road. Keep that term hawk in your mind, because that reputation is exactly what makes this whole situation so puzzling.
Which brings us right to the heart of the matter, the big conflict swirling around his nomination. Is he still that same inflation hawk? Has he become something else? Or is he, as some critics suggest, just a political instrument?
And this is where you can really see the contradiction. On one side, you have the hawkish Kevin Warsh of the past, who fought tooth and nail against easy money, and on the other, you have today's nominee, who sounds a whole lot like Donald Trump, calling for lower interest rates, the very policies he built his career opposing.
This apparent 180 has drawn some really sharp criticism. Senator Elizabeth Warren, for example, did not mince words. She called him a sock puppet, basically saying his views just seem to mirror whatever Donald Trump wants, even if it completely contradicts his own record. That accusation gets right to the heart of the opposition he's facing.
So that leaves us and the entire market with this massive trillion-dollar question. Has he had a genuine change of heart about economic policy? Or is this just a calculated political move to land the most powerful economic job on the planet?
And finding the answer to that question is absolutely critical because of the unbelievable amount of money the Fed controls. Which brings us to the big one, the $4.5 trillion question.
Okay, so right now, the Federal Reserve is sitting on $6.6 trillion on what's called its balance sheet. The easiest way to think about this is like the Fed's giant investment portfolio. It's packed with assets like government bonds and mortgage-backed securities that it bought over the years to keep the economy stable, especially during a crisis.
This chart really puts that number into perspective. Before 2008, the balance sheet was less than $1 trillion. Then the financial crisis hit, and boom, it exploded. Then the pandemic hit, and it exploded again. Now, Warsh has publicly called this bloated, and he's made it very clear that shrinking it would be a top priority.
But, and this is a huge but, there's an enormous risk. If the Fed starts selling off those assets too quickly, it could flood the market, causing bond prices to crash and interest rates to spike. We actually saw a preview of this back in 2013 with a taper tantrum, when just the hint of the Fed slowing down its asset purchases caused a global market panic. A similar move today could wipe out an estimated $4.5 trillion in value across stocks, bonds, and real estate. The stakes are incredibly high.
Now, I know $4.5 trillion can feel like some crazy abstract number, so let's bring this down to earth.
Let's talk about what a Chairman Warsh could actually mean for your money.
So how does this translate to your bottom line? Well, if Trump gets the lower rates he wants, the interest you earn on your savings will likely fall. Your mortgage is more complicated, lower Fed rates could be canceled out by other actions, keeping your payments high. Your 401k could see a lot of volatility as investors try to guess which Warsh will show up. And job security? That really depends on him. Finding a delicate balance, keeping rates low enough for businesses to grow and hire without letting inflation get out of control.
Okay, let's walk through this mortgage puzzle, because it's a little tricky. Step 1. The Fed cuts its main interest rate, which should make loans cheaper. But Step 2. Warsh also wants to sell off the mortgage bonds the Fed owns. Step 3. When you dump all those bonds onto the market, it pushes their prices down and their interest rates up. The result? These two actions could basically cancel each other out, leaving your mortgage rate stubbornly high even when the Fed is supposedly cutting rates.
Now, of course, all of this is a big if. None of this happens unless Warsh actually gets the job. And believe me, that is far from a sure thing. He is facing a serious confirmation fight in the Senate.
The vote is going to be on a knife's edge. Republicans have a slim majority, but they really can't afford any defections. And they already have one. Senator Tom Tillis, a Republican, has come out against the nomination. With Democrats united in their skepticism, Warsh's confirmation is going to boil down to one single question he must answer to the Senate. Is he independent?
And Senator Tillis's own words really highlight the core concern here. He said that protecting the Fed from political interference is non-negotiable. This isn't just a partisan issue for many of these senators. It's about a fundamental principle of politicizing our economy.
So in the end, it all comes down to this. Will the next Fed chair be an independent steward of the economy, guided by data, or will they be a political tool, guided by the president? The answer to that question won't just shape the markets, it will directly impact your financial future for years to come.